Good evening, friends. Today we have the next session of the BCAS Gurucool, an initiative of the Bombay Chartered Accountant Society. I'm Toral Shah, Chartered Accountant, and our today's session is going to be on updated return of income under section 139(8)(a). So what are we going to cover in this presentation? So there is going to be a brief introduction about the section. When can one file updated return of income? Tax payable while filing updated return of income? Who can file and who can not file an updated return? What is the advantage? Why should somebody file an updated return? And key difference between updated return and revised return. So introduction. So who can file an updated return? So all SSEs, be it a company or an individual, an HUF, all SSEs are eligible to file an updated return. Now, is it necessary that I should have filed my return? Only then I am eligible to file an updated return? No, that's not the case. So even if you have filed your original return, thereafter you have even revised your return, or you did not file your return within the due date, but you filed a return later within the due date for a belated return, or you never filed your return of income. In all the circumstances, you are eligible to file an updated return, of course, subject to the other conditions prescribed. So what is the difference? SSEs can file an updated return by paying additional tax. So there are additional taxes, whether you are filing your updated return within 12 months or within 24 months from the end of the relevant assessment year, the taxes will be different. We will discuss about that. So this provision has been introduced by the Finance Act 2022. And the first updated return that an SSE can file is for the assessment year 2021. And the last date for filing that is 31st March 2023. Now, who can file an updated return of income? So can any SSE who wants to get his refund or has failed to file his return and has a loss can file an updated return? So no. One thing we have to be very clear is then updated return is only a method by which the government can get some additional tax dues. This is not for an SSE to avail any benefit. So the government has prescribed conditions when an updated return can be filed. So it can be filed when there is a loss return, but originally filed, and the loss return has to be converted into a return of income, which will be a positive income. So if you have a loss of 10 lakhs and you want to reduce the loss to 5 lakhs, no, then you cannot file the return, updated return. If you have a loss of 10 lakhs and your updated return is going to be a positive income of 5 lakhs, yes, then you can file an updated return. Or you can file an updated return where there is an error or omission, which if rectified in the updated return will result in two scenarios. One, it will give some additional income and additional tax liability to the department, or it will reduce your claim for refund. So if you have filed a return of income where the refund is 10 lakhs rupees, now you are going to file an updated return where the refund is going to be less than 10 lakhs, say 5 lakhs. Then yes, you can file your updated return. So these are the three conditions under which under law you are eligible to file an updated return. So, and consequentially, there will also be requirement to file an updated return for the subsequent years. Say, for example, you filed an updated return for assessment year 2021. Originally, it was a loss return of 10 lakhs rupees. Now you're filing an updated return by filing an income of 2 lakhs rupees. This 10 lakhs rupees was claimed as an set off in the subsequent financial assessment year, that is assessment year 21-22. Now, because the assessment year 2021 is no longer a loss return, even your 21-22 assessment year return is now not a correct return. So you will also be required to rectify your 21-22 assessment year return. Now, why should you file an updated return for 21-22 as well? Because now the due date for filing a revised return for 21-22 is not available. Had you realized the mistake within the due date, which was December year end 22, December 22 was the date for filing the updated revised return for assessment year 21-22. Had you done that, then you would not have filed updated return. But because that due date of revised return has gone, once you update your return for assessment year 2021, you will be required to also file an updated return for assessment year 21-22. The department has prescribed from ITRU, which has to be filed for filing your updated return. So what are the circumstances or what are the scenarios that could arise and when you should go for an updated return? What is the difference? So this is an example where if your return is filed you have realized there is an error in the return of income, and you are considering whether I should sit quiet or I should go ahead and revise, file an updated return. Here, the time for filing a revised return has already passed is the assumption. So now I have created 3 scenarios and the working of text under the different scenarios, which will give us an idea of what is the difference in the actual total outflow under the 3 scenarios. The first scenario is where your return is selected for reassessment and the time for reassessment is 6 years. So assuming in the 6th year a return is selected for reassessment and income of the company is 90 lakhs rupees, and which is not disclosed. So now if I were to pay the normal taxes under the 3 scenarios, it is 25%, 25.17%. We are assuming a company which has opted for 115 BAA. The additional income is going to be 5 lakhs rupees. Now, the number of months for which 234B is going to be computed is 72 months, because in reassessment, we are assuming the reassessment has been opened after within 6 years, the 6th year. You are filing an updated return within 12 months, that is 24 months. You will have to pay interest for under 234B for 24 months, therefore. Or you are filing an updated return after 2 years, that is 36 months from the first day of the financial year. So the interest under 234B will be 90,000, 30,000 and 45,000 in the first, second and third option respectively. Now, under the updated return, you are also required to pay 25% of additional tax if you are updating your return within 12 months from the end of the relevant assessment year. And for your tax rate, additional tax is going to be 50% if you're filing within 2 years from the end of the relevant financial year, assessment year. Sorry. So the additional tax is 39,000 and 85,578 respectively. So the total tax liability in the 3 scenarios will be, as mentioned here, 2,16,000 approximate, 1,95,000, 2,56,000. So first, our normal presumption would be that if 12 months have already passed, why should I file an updated return? Because under reassessment, my tax is only going to be 2,16,000. And in the updated return, I'll have to pay 2,56,000. Well, that is not the case, because there is also a penalty which will be applicable if the income is identified in reassessment. The penalty could be ranging from 50% to 200%, depending on whether the department considers that income as having been underreported or misreported. So if you add the penalties, then the scenario changes completely. So in the first option, if you consider penalty as 50%, then the total tax is going to be 3,24,000. And if the penalty goes up to the maximum of 200%, then your tax liability will shoot up to 6,49,000. So now when you compare, you will realize that it is better to go for the updated return rather than to wait and try your luck and see if whether assessment comes up or not. Now, the question is, it is not that everybody can file an updated return. Even if it is an income return, the updated return is not a facility which is available to all SSCs. So let us see who cannot file an updated return. So if for one assessment year, I identified an error and I filed an updated return. Now again, I'm coming up with a surprise that I've missed some other income in my return of income. But unfortunately, there is no way I can again file an updated return. I can only file it once. Now, if my case has already been selected for assessment or reassessment or revision, and the proceedings are either ongoing or they have already been completed, then I do not get an opportunity to file an updated return. If there has been an exchange of information under section 90 or 90A and some information has already been shared with the department, then I cannot file an updated return. Where the information is available with AO under certain acts and they have been communicated to the taxpayer. Say, for example, the AO has some information of money laundering under the PMLA Act or under some information under the Black Money Act or Benami Property Act. And that information having come to the AO has also been communicated to the taxpayer that we have got this information about you. Then that SSC cannot file an updated return. The government has also kept it open that they can prescribe any person or class of persons who will not be eligible to file an updated return, which is not yet notified. No person is notified so far. Also, SSCs where search has been conducted or survey has been conducted or initiated, and the search and survey proceedings are ongoing, the SSCs cannot file their updated return. Also, SSCs in whose case prosecution has been launched and is ongoing, they cannot file their updated return. The question is, why would anybody want to go for an updated return? So the advantage of going for paying additional tax liability of 25% or 50% and going for an updated return is the SSC gets two benefits. One, you get immunity from prosecution proceedings. Once having declared and come clear, there will not be any consequences of prosecution, and also there will not be penalty consequences. So by paying this nominal amount or a little additional amount, you can sleep peacefully. So this is a quick, short comparison between updated return and a revised return. So the advantage, what is the government's intention of coming out with an updated return? So if an SSC has missed his opportunity to file a revised return, and they have also curtailed the time within which a revised return can be filed, but still they are giving you an opportunity. Okay, if you have still come across any error, we allow you an opportunity, but definitely that opportunity will not be free. It will come with its own costs and terms and conditions. So here is a quick recap on what is the comparison between an updated return and a revised return. So first and foremost, the time frame that is allowed under both the scenarios is different. I can file an updated return within 24 months from the end of the relevant assessment year. So I get a long time frame. However, the revised return can be filed only up to 9 months from the end of the relevant previous year. So an updated return can be filed even if I have filed an original return of income, or I have not filed an original return of income. I've completely missed out on filing a return of income. However, a revised return is available only if you have filed an original return. Of course, you have the belated return provision as well, but again, there the time frame is same as in the revised return, 9 months from the end of the relevant previous year. Updated return can be filed only if there is additional tax liability. As we discussed earlier, I cannot file an updated return to claim a higher refund, claim higher loss. I can only file an updated return when there is an additional tax outflow or there is a reduction in my refund. However, a revised return is an opportunity where SSC can also claim the benefits which he has missed out while filing his original return of income. Again, as we discussed, updated return cannot be filed if it results into additional refund, but revised return is available in that case also. Updated return takes a larger pie out of your savings. It takes away 25 or 50% of the tax as additional tax, whereas there is no such additional tax liability. And in a normal revised return, you pay as per your income tax slabs. And of course, if you had missed paying the due taxes, the interest under 234B as applicable. Now, these are some examples to clarify what are the scenarios where you can file an updated return or not file an updated return. So in this case, Mr. A, a salaried person, has filed his return of income for assessment year 21-22 well within his due date, and he has declared 10 lakhs as his income. Thereafter, he notices that in his return of income, he has not disclosed long-term capital gain of 10 lakhs. But he has also suffered short-term capital loss of 2 lakhs, which again he has not disclosed. The question is whether he can file and how he will be required to file the return. So in this case, the long-term capital gain minus the short-term capital gain is a net capital gain of 8 lakhs rupees. When you add that 8 lakhs of capital gain to the total income which is already declared, the total income, revised total income comes to 18 lakhs. That means your total income and tax payable as per the original return will increase in the updated return, and so you will be eligible to file your updated return. In this second scenario, Mr. A has filed his tax return of 10 lakhs as we already saw. He has a long-term capital loss of 8 lakhs rupees and a short-term capital gain, or income from other sources of 2 lakhs rupees. As we all know, long-term capital gain is not eligible for set off against salary income or income from other sources. So what will happen if he wants to update his return of income? The updated return will look like this. Total income will be 10 lakhs plus 2 lakhs of other sources. Total taxable income will be 12 lakhs and there will be a carry forward loss of 8 lakhs rupees. So in this case, by paying additional tax on the 2 lakhs of amount, he will be eligible to carry forward his 8 lakhs rupees of loss. So here, by paying additional tax is better off, because in the next year when he has a long-term capital gain, that 8 lakhs rupees which he has now been able to carry forward will be available to him as set off. Sorry. So these are some simple examples which we discussed. So if we have to conclude, updated return is a very good provision, because within the short time of available for filing a revised return or a belated return, there are many instances when we practically come across errors in the previous year returns when we are filing the next year's return. But by that time, the due dates have gone for revised return as well as belated returns. That is why this updated return provision is a welcome move for people who want to come out clean, sleep peacefully. Yes, agreed, there is definitely an excess outflow, but still it is an opportunity where you get immunity from prosecution, immunity from penalty provisions, and you are peaceful after filing your returns. So definitely a welcome move. Thank you very much. Thank you, viewers. We welcome your suggestions and feedback on the email ID bcastaxation@gmail.com. bcastaxation@gmail.com. Thank you very much.